The truth behind mortgage quotes, always a hot topic and the subject of today's episode of Mortgage Deep Dive. My name is Jason Gordon. I'm a residential mortgage specialist. Some of my credentials are listed on this slide. The only sales pitch you're going to hear on this entire video is right now, I originate mortgage loans for a living, and I'd be happy to help you and or those you care about. Let's move on to my contact information. My cell phone is 619-200-8031. You can email me at jasongordonmortgage@gmail.com. You can download my electronic business card at vipborrower.com. That electronic card is going to have access to my social media, my online reviews, my loan application, my mortgage calculators, as well as a lot of additional information. So feel free to put that in your phone. It's better to know me and not need me than need me and not know me. As far as legal disclaimers to keep myself compliant, this video and all videos that I produce are for educational purposes only. We are not giving any legal and or tax advice. And despite the fact that today's topic is about mortgage quotes, nothing about today's video is to be construed as a direct mortgage quote to you and or an offer to lend. I'm an equal housing lender and my NMLS ID is 259027. So let's jump on in here. The first bit of information that you really want to know about mortgage quotes is that there are two different ways that we all pay. The first one is the upfront cost to create your loan. If I ask you just by itself, do you want to pay high cost or low cost? The answer is obvious. Of course, you want to pay low cost. But the second category is the interest rate, which is the ongoing cost of borrowing that money over time. That interest rate impacts not only your monthly payment, but the amount of finance charges you pay over the life of the loan. So if I was to ask you just by itself, do you want a high rate or a low rate? The answer is just as obvious. But folks, here is the dichotomy. You do not get both categories at the bottom of the spectrum at the same time. So a good summary statement here is the more you pay in cost, the less you pay in rate, and vice versa. The less you pay in cost, the more you pay in rate. We call that combination pricing. So pricing, if you really want to know your rate quote or your mortgage quote, you want to know the pricing quote, which is not only the interest rate, but also the closing cost. Or spin that around, not only the closing cost, but also the interest rate. And I would also say you also want to know about the product as well, because not all loan programs are priced identically. But today we're going to focus on the combination of the rates and the fee, which we call pricing, so that you can make better decisions moving forward. So let's take a look at a specific case study. On this screen, you see search criteria. The highlighted areas on this screen represent the items of the search that tend to move the needle the most on a rate quote. So as I'm going over these different criteria, I want you to keep in mind how awkward it is when one of us is contacted by one of you demanding a quote without giving us information, okay? Because different information is going to have different quotes attached to them. So in this example here in the upper left-hand corner, we have a proposed new loan amount of $450,000. The property value is estimated at $600,000. The first takeaway here is that we divide the loan amount by the property value to get what's called the loan to value, which we abbreviate LTV. In this case, $450,000 divided by $600,000 is a 75% LTV. Make note of that on the quote. Different LTVs will kick out different rate quotes. So equity matters. Now, the loan type, there are two main categories of loans that lenders help you with. We have purchase loans when you're looking to get a loan to purchase a home. Then you have refinances when you already own the property and you're just redoing the existing mortgage. Now, there are two different categories of refinance. There's rate and term and there's cash out. While other differences may be present between the two, for ease of conversation, just consider rate and term, you replacing old loan with new loan and getting no more than $2,000 in cash at closing. Now, cash out, on the other hand, as the name suggests, allows you to get more than $2,000 in cash. So in this case, we're looking at a rate and term refinance with zero cash back. Down below here, we have the FICO score, something we all have heard of by now, which is your credit score. The higher the score, the better. Depending on the program that we're accessing, you have what are called tiers, as in TIERS. We call them FICO score tiers. They usually operate in 20-point increments if we're looking at Fannie Mae, Freddie Mac, conventional, also known as conforming loans. So one tier might be between 680 and 699. The next tier, 700 to 719. Next tier, 720 to 739. Typically, on most programs, 740 plus is the highest tier. So there's no difference in rate quote between an 800 credit score and a 795 credit score. Just know that if I communicate a 795 credit score and you say it should be over 800, it's probably not going to change the quote. But I do understand the pride we all have in our credit scores. Just know that 740 plus is typically the highest tier. You see on the criteria here, I've used a 740 score. Now, the property information is also very critical, starting with occupancy. There are three categories of occupancy. We've got owner occupied, which means it's your primary residence. You live in the property now. There's also second home, which means this property is not your primary. There's no renters in there. You just have a second home to go to whenever you want to. The third one is what's called an investment property, also known as non-owner occupied. Rate quotes are significantly different between primary residence and investment property. So you see here, we have primary residence, which means our borrower lives in the subject property. Now, about that property, it could be a single family, it could be a condo, a manufactured home. In this case, we have a single family residence. The units, it could be 1 to 4 units. In this case, it's a 1 unit. So primary residence, single family, 1 unit. Down below, we're looking for a conforming loan, a 30-year term, fixed for the entire terms. In this case, we call that a conforming 30-year fixed. Here is what the rate sheet looks like. So as you look at this rate sheet, if this is your first time seeing one of these, wow, a lot of information is packed in on one screen here. To make it a bit easier, I'm going to color in some of the fields here for you and give you an idea of how to read this. Now, there are different types of formats in my industry. This is the most common software program that lenders use, at least at the time that I'm recording this video. In the upper right-hand corner in yellow, we see the search date and time. I'm recording this video in February of 2023. This rate quote in this image was taken nearly 1 full year ago on March the 8th of 2022. To the left, up on the top here, we have what's called a lock period. Your pricing, your combination of cost and rate is either locked in or it's not. If it's not, we call that floating. There is no third option. In this example here, we have pricing based on a 30-day lock. So as of this date, March 8th, 2022, if I locked it in for 30 days, I'd have to fund that loan no later than April 7th of 2022. The longer your lock period, the less attractive your pricing. So we lenders try to calibrate the lock period to enable us to have enough time to get the loan done. Now, in this case, the left-hand column shows the interest rates. So the first major takeaway here is that there's a lot of different interest rates on a rate sheet. So if you demand to know what's your rate and tell me right now, we don't answer the question right away, it's because we have a lot of interest rates on the rate sheet. Now, if there, in this case, we have rates between 2.25 and 4.75. By the way, odds are when you're hearing this video or watching this video, rates are higher in the present day. This was right before the global pandemic when the economy was starting to take a pretty big hit. Rates are probably higher. I hate to bum you out, but that's just, this happens to be a quote back in February of 2022. But looking at this column here, If there was no distinction between a rate of 2.25 and a rate of 4.75, we'd all pick 2.25, right? Why even have the other rates on the rate sheet? But as I mentioned earlier, there's a correlation between the rate you take and the acquisition cost that you pay. So we'll get to that in just one moment, but this column here on the left, where all the rates are in gray, works in harmony with this column over here to the right, kind of in this pinkish purplish color. This is labeled P&I. P&I stands for principal and interest. Principal is the amount of money you're paying back over that 30-year term. Interest, again, is that ongoing charge of borrowing the money. If you recall, we had a 30-year term on the search criteria. We had a $450,000 loan amount on the search criteria. All we need at this point to calculate the P&I portion of the payment is the interest rate. So as the rates go from low to high on the left-hand column, the payments in the pinkish column over here, or purplish column, go from low to high on the right-hand column. Now, it bears noting on this right-hand column, a couple of items here. These payments are rounded to the nearest dollar. More significantly, these payments do not include property taxes, homeowners insurance, Mello-Roos, HOA dues. This is simply the principal and interest portion of your payment. We'd have to manually add on items like taxes, insurance, if there was mortgage insurance, Mello-Roos, HOA, to your overall housing payment. Now, the market's constantly moving. What actually moves throughout the day on any given business day and overnight between business days, it's actually not the rate column that moves. What moves is this yellow column next to the rate, which is labeled price. This is the price of each interest rate. Now, for ease of use here, we have a red line that I've drawn already on here to show you that lender's price in the yellow column to 100.000. We call that par. Now, I realize par is a golf term. Think of par in this context as going to the beach and seeing where sea level is, right? Where the air meets the water. Every one of these options in yellow is going to be priced to 100. Now, you'll notice above this red line, all the numbers that are less than 100 correspond to the lower interest rates. We have to do some math to get that to 100. So the math, by the way, is done for us in green. Yes, the yellow and the green column work in harmony with each other. So let's take an example here. Let's look at the 3.375 interest rate. And let's just go right across that line there. We see in yellow, it's at 97.750. But we need to get it to 100. What do we need to add to 97.750 to get to 100? Well, the math is done for us over here in green. Now, the green column has a left side and a right side. The left side does the math against the yellow to get you to 100. So we see here that 2.250 added to 97.750 would get you to 100. Now, here is the big difference. Please pay attention. We take that loan amount of $450,000, we multiply it by 0.0225 or 2.25%. And what we get is shown here on the right-hand column in brackets. In this case, that interest rate, because it's below par, would cost over $10,000 more in closing costs. So now that you know how that correlation works, let's take a look here from the red line and move up. As the rates go lower, the cost gets higher. So that 2.25 that you were looking at earlier, that looked really good, cost almost $40,000. I'm not letting you pay $40,000, folks, just so you know, okay? But that some of these quotes on there, they can have quotes on the airwaves. In this example, on this day at 2.25, and technically it's on the rate sheet. But who's going to pay $40,000, right? Now, below this red line, you see numbers in yellow that are greater than 100. We are still trying to get the numbers to 100. So if it's over 100, now we're going to subtract a number. So let's take a look here at 4.125. We see next to it 100.750. Well, that overage here of 0.750 belongs to the consumer as a credit to reduce their closing cost. So here in the green, we have that 0.750 is now a negative number. And we see here, there's a negative number of $3,375. This credit could be applied to some of the third-party costs, such as your escrow company fees, the title insurance, the appraisal, the notary, the county recorder. Even some of your recurring costs can be credited out of this money here. So let's take a look at what that means. Now, let's say you got two quotes, lender A and lender B, and all you were asking for was, what are your closing costs? Lender A said 4,000. Lender B said 400. Well, gosh, what a huge difference between 4,000 and 400. I must have found the magic bank. Did you get a rate quote? Because in this example here, depending on the loan amount, the math is different in the brackets here, but let's just say that one lender was quoting 3.875 with that 4,000 in cost, and lender B was quoting 4.125 with this $3,300 credit. Did you really get a better quote? Maybe you did, maybe you didn't. Obviously, the numbers vary constantly and the math is different on each loan amount. But the concept here is what you want to know is the importance of getting not just the rate quote and not just the closing cost quote, but both at the same time. And ideally, the lender's giving you a few different options, right? In this case, 3.5 is going to be at a 1.625 point cost. 4% is going to be at a credit of 0.375. Get as many quotes as you want. And ideally, you're working with a lender that's going to show you this information, be transparent so you can see what is going on behind the curtain so you can make an informed decision. Now, you remember in math class, the teacher always said to show your work. This area here in turquoise is the lender showing their work. In other words, this quote is a customized quote. Look over here to the left in the turquoise area. We have kind of two different features that correlate with each other. We have, remember the loan to value or LTV, we had it at 75% when we divided the loan amount by the market value of the home. We have a tier, again, TIER, between 70.01 and 75.0. We were at 75.0, so we fell in that tier. We have a credit score at or above 740. Remember, we used the 740 score. The pricing adjustment was nearly nothing. At the bottom here, you have a very small pricing adjustment. Pricing adjustments are not your friend. The bigger the adjustment, the worse your quote's going to be. So this is practically no adjustments. This is a very strong quote because the borrower is strong on paper. And this is never personal. We don't care about your race, religion, gender, creed, marital status. We do care about items like your credit score, the equity, the property type, the loan purpose, the occupancy, things like that. So now, in this example here, we have what I would call a very highly qualified borrower who's getting a very attractive quote. Now let's look at a different scenario here. I'm going to make only one change. Everything is the same loan amount, 450, same value, 600, same LTV, same loan purpose, rate and term refinance, primary residence, single family, 1 unit, conforming 30-year fix. But now we're going to use a lower credit score. In this case, 670. My, oh my, what a difference a credit score can make. Now we actually see a number that landed on par, right? In this case, 4.750. Remember, the previous quote, I'll go back to it just for visuals here, was between 3.875 and 4%. Technically, 4% was giving a credit back of $1,688. 4.75 was the highest rate on the rate sheet, was given a $10,125 credit. Now let's go back to that 670 credit score. 4.75 is now a par rate, giving no credit. So you lost that $10,000. And if you wanted that 4% that was giving you some credit back before, you're paying nearly $8,000 for it, all because you had a 670 credit score. and look down below in the turquoise. There's the adjustment. Same LTV, but now we have a lower credit score. In this case, FICO score between 660 and 679. That 670 score is right smack in the middle. There's an adjustment of 2.25%. So folks, credit scores absolutely matter. If you have a 670 score and you're out there getting quotes for a 740 because you won't let the lender pull your credit, be prepared for an uncomfortable conversation when the lender does eventually pull your credit and sees a lower score. They have to adjust the rate quote to the specifications of the borrower. Let's look at one last scenario here. I'm going to make a few changes, all for the worse, just to give you some perspective. Okay. Now we took the loan amount from 450 to 480. So we're going to give the client back some cash. Same value of 600,000, but now you divide the 480 by the 600. Now we're at 80% LTV. That's going to put us in the next tier of LTV. We go from a rate and term refinance to a cash out refinance. That's going to cause an adjustment. And the cash out in this case is $30,000, which is the difference between the previous quote of 450,000 loan amount and this quote of 480,000 loan amount. There's that same 670 credit score, which was the not so good score based on the first two quotes. Same information down below. Primary resident, single family, 1 unit, conforming 30-year fixed. You ready for the new rate quote? Ouch. First of all, look at those numbers. They go from 3.250 to 5.50 on the same day. Look at the numbers in yellow. None of them even got to 100, which means that each one of these rate quotes is going to involve additional fees. I've highlighted the 5.25 rate here. We see it's at 99. What do we have to add? What do we have to add to 99 to make it 100? We add 1. In this case, this is 1 point, which on a 480,000 loan amount is $4,800 at a 5.25 rate. Why is that? Look at the turquoise down below. Look at this collection of adjustments, nearly 5 points when you factor in the higher LTV, the lower credit score, the cash out feature. These are examples of pricing adjustments in action. So the takeaway here is if you are insisting on a quote without giving the lender any information, we are quoting you blindfolded. Doesn't do you any good. You're not shopping around properly. You're not doing your due diligence. Let the actual lender do their job to get all this information so you can get a specific rate quote for you. And remember that that quote is for you specifically on that day at that time. The market can move. So let's look a little bit closer here. When I say the market can move, let's do a live example. I'm going to break out of this PowerPoint for a moment here and show you modern day examples here of what's going on. Again, I'm recording this video here on February the 10th of 2023. Let's look at what the market is doing. So these red and green items on the chart here, we call these candlesticks. Each candlestick summarizes the activity of the market for one business day. I'm going to explain to you in 30 seconds here how to read this chart, and it'll make a lot of sense for you. Okay. Now, first of all, this chart is impacting the yellow and green sections of the rate quotes I showed you just a few moments ago. Remember, the rates don't change. It's the pricing that changes. This screen is the playbook that all lenders across the country use to alter their pricing whenever the stock market is open. So over here to the right, we have today's candlestick. This goes back, in this case, 3 months. Each candlestick is one business day. The only one that's in action right now is this one here on February the 10th, because the market is open as I'm recording this video. The rest of these are historical. So how do you read this chart? Remember, I'm on your side as I'm giving you this explanation. Green is good news. Red is bad news. The bigger the colored portion of the stick, the more the market moved in that good news or bad news direction that day as a whole. So in this case, very big green, good day. Very big red, bad day. Here's the kicker, folks. The higher the sticks appear on the chart, the better it is for your quote. The lower the sticks appear on the chart, the worse it is. Now, that might seem a little bit backwards, right? Shouldn't low be good when I'm talking about rate quotes? These candlesticks are measuring mortgage-backed securities. Mortgage-backed securities are bonds. Bonds and rates go in inverse directions. So to keep it real simple, green up is good. Red down is bad. You can start seeing what's going on here. As of the last couple of days, we've had a really bad performance here in mortgage pricing. Look at that big red and look at that huge jump between where this finished on this one day and where it opened on the next day. Ouch. Here we are now. We're on a bit of a bad run. Now, when I pull this back to 6 months, you can start seeing a bit more of what's going on, a little bit, larger trajectory of where these candlesticks are. When I pull back to a year, you can really start seeing what's going on. When I pull back 2 years, now we're picking up some of the global pandemic area right here, right? Look how high the sticks were during the pandemic when all that bad news for the economy was going on. This was good news for mortgage quotes. As the economy started getting better, inflation started rising, we started seeing this get worse and worse and worse. Had a couple of recoveries here and there and a couple of just bouncing up and down. The point of this whole thing is that the market constantly moves. Again, Monday's quote is not good on Tuesday. January's quote is not good in February, much less later in the year. Now let's go back to our slides here because I'm going to show you an example here of the mortgage pricing changing over time. Let's go back now to look at that same first scenario. Remember the good scenario we had, that A paper borrower, the $450 loan amount, the $600,000 value, the 75 LTV, rate and term with a high credit score. When I pull this same quote in November of last year, about 8 months later, remember the first one was in March, this is now November, same criteria. Now the rates go from 5.75 to 7.625, and par is at 6.625%. But earlier in the year it was at 3.875 to 4% range. Right now it's 6.625. Remember, there's no adjustments here or nothing significant here. This is an A paper quote, right? Low LTV, high credit score, rate and term, 6.625 at par. What if I look at that not so attractive quote, that last quote I gave you, the one that had kind of the worst of all the adjustments, the 480 loan amount, the 600 value, the 80% LTV, it being cash out and having the lower credit score? Oh my goodness. In, just 8 months later, in November of 2022, you're at 7.625 and you're paying 3 points. That's doubling the rate practically and significantly increasing the cost because there's all those adjustments when the base pricing was a lot higher due to the market moving. So in summary, folks, the market is going to move. We can't stop it from moving. None of us have a crystal ball. Good news for the economy is bad news for mortgage rates and vice versa. There is a correlation between the cost you pay and the rate that you get. You've seen the combinations that we have. There's plenty of them. If you are in the market to get a loan anytime soon, or somebody you know and care about is, whether that's friends, family, neighbors, coworkers, if it's one of your clients, if you are a real estate, financial, and or legal professional, do the diligence properly. Share this video. It's a bit longer than these 30-second sound bites, but it's a deep dive meant to give you the information that you need to make informed decisions. I want to thank you again for your time and attention today. My contact information is back on the screen. I'm Jason Gordon. I appreciate your time and wish you the best. And if I can help out in any way, please reach out to me. Thanks, folks.